Banks incorrectly assume the difficult work of the ISO 2022 migration ended in 2025, overlooking a severe enforcement phase scheduled for 2026. It was an exercise in basic format translation, shifting legacy MT messages into the newer, structured MX framework. The incoming November 2026 mandate operates on a different logic. It introduces a strict enforcement of data integrity that will break older legacy workflows relying on unstructured inputs. Previously, banks simply converted completed messages into new formats. The next phase requires institutions to generate and prove the accuracy of structured data across the entire payment lifecycle. Despite this, much of the industry treats the upcoming deadline as a minor IT update, neglecting the necessary operational overhaul. The industry is failing because it views 2026 as a messaging chore, ignoring the requirement for a total upstream data transformation. The 2026 deadline carries two specific regulatory changes. The first is the complete termination of unstructured postal addresses in the CBPR Plus payment network. CBPR Plus stands for Cross-Border Payments and Reporting Plus, the working group defining how ISO 20022 is used for international payments. The second challenge is the forced migration of exceptions and investigations from free text messaging to structured CAMPT workflows. CAMPT refers to cache management messages within the ISO 20022 framework, specifically used for reporting, investigations, and returns. This forces the industry to abandon 40 years of flexible, email-style communication protocols in favor of rigid, predefined case management logic. The data reveals a significant gap. 45% of institutions are treating these structural shifts purely as a compliance tick box exercise, while only 10% are attempting a major workflow transformation. Treating two deeply interconnected operational transformations as isolated compliance tasks guarantees severe processing delays and rising operational costs. To understand why these systems will fail, look at the standard linear journey of a cross-border transaction. It moves from the initial corporate client through onboarding and core banking systems, into the payment engine, and finally out to the clearing network. This reveals the formatting fallacy. A modern payment engine can only validate and output the exact data it receives from the systems upstream. Fewer than 50% of core banking and KYC platforms natively support structured addresses. The precise failure occurs here. An upstream system sends a free text address, triggering an immediate validation failure at the payment engine. This results in a swift rejection, delayed funds, and regulatory scrutiny. Because banks updated their payment engines first to meet the 2025 deadlines, those modern gateways are currently masking the severe data rot hidden with an older underlying architecture. Fixing this requires a significant technical undertaking. Institutions must execute schema redesigns and data model updates within embedded systems that are frequently decades old. The bottleneck destroying compliance resides in deep-seated legacy archives housing decades of unverified, unstructured customer records. Internal technical compliance offers zero protection if the external inputs to the bank are flawed. The corporate clients themselves are a secondary threat vector. This chart isolates data from Tier 1 institutions, banks with over $250 billion in assets under management. It shows nearly half of their corporate clients remain unmigrated. Compare that to the industry average, where 32% are unmigrated. Corporate enterprise resource planning and treasury systems are persistently outputting messy, free text data. The bank retains the legal obligation to clean and structure that data before transmission. This places a significant operational burden on the institution, deploying slow manual remediation, purchasing expensive AI cleansing tools, or forcing clients to redo KYC. A flawless internal IT architecture means nothing if a bank fails to educate, align, and strictly mandate structured data formats from its own counterparty network. The second mandate hitting in 2026 is the eradication of unstructured MT199 and MT299 messages. These open text formats have governed problem resolution in corresponding banking for 40 years. The new mechanics of the CAMT standard replace that flexibility, Tracing lost payments now requires rigid, predefined categorization logic and highly specific purpose codes. For back-office teams, this is a significant operational shock. They must transition from flexible, bilateral email-like discussions to interpreting and managing automated data flows. Survey data reveals a critical contradiction regarding this shift. 60% of banks plan to use this exceptions and investigations reform to consolidate platforms and reduce costs. This diagram compares that ambition against the execution reality. Only 37% of banks have actually implemented a unified, centralized program capable of achieving those goals. The majority are operating under the parallel model. Compliance, operations, and IT departments are all attempting to upgrade their respective systems entirely in silos. When these independent, siloed updates are finally forced to interact, the result is immense friction and systemic breakdown. These silos result directly in misaligned validation logic, duplicated engineering effort, and the introduction of dangerous control gaps into the payment workflow. The alternative unified model relies on central governance. A single authority takes responsibility for redesigning the workflow end-to-end, rather than simply patching individual software applications. Without unified oversight, institutions spend millions on isolated IT patches, completely missing the promised benefits of workflow simplification and sustainable cost reduction. Structured address remediation and exceptions and investigations reform are not independent projects, they're on a direct collision course. Poor upstream address data guarantees an immediate spike in false positive hits within financial crime and sanction screening engines. Those false compliance hits trigger a domino effect. They instantly generate a wave of rejected and paused transactions across the entire network. This network map illustrates the cascade. This spike in rejections floods directly into the bank's newly structured, yet entirely unoptimized case management workflows. Executing siloed compliance projects compounds the operational pressure. Banks will successfully solve one bottleneck, only to completely paralyze the next node in the chain. Their strategy involves weaponizing the ISO 2022 mandate as a foundational baseline to enable advanced analytics, AI-driven automation, and instant payment tracing. This yields a significant competitive advantage. These firms achieve faster resolution times, vastly reduced manual touchpoints, and lower post-enforcement operating costs. The November 2026 mandate exposes institutions relying on fragmented IT patches while rewarding strict, centralized data governance. The regulatory deadline is fixed and unavoidable. That's today's signal. Don't forget to subscribe to the channel.
The payment signal. Are you tuned in?